What's good, crypto family? Boni here. And if you're watching this on August 19th, 2025, then you're probably feeling the same market tension I am right now. Bitcoin just kissed $115,400. Ethereum is dancing around $4,280. And honestly, the charts are looking like a Jackson Pollock painting right now. Beautiful chaos that either makes perfect sense or no sense at all, depending on how you look at it. Now, before we dive into today's analysis, let me ask you something. Have you ever been in a relationship where everything seems perfect, and then suddenly your partner starts acting weird, giving you mixed signals, and you're left wondering if you should hold on or cut your losses? Well, welcome to Crypto in August 2025, because that's exactly what Bitcoin is doing to us right now. Today, we're going to dissect the past 24 hours like a forensic analyst, understand what the big players are really thinking, and most importantly, I'm going to give you a concrete strategy for the next 24 hours that could either save your portfolio or position you for some serious gains. So grab your coffee, turn off those TikTok notifications, and let's get into it. Let me paint you a picture of what happened in the last 24 hours, because if you blinked, you might have missed some crucial moves. Bitcoin dropped 2.54% to $115,400, which might not sound like much, but when you're talking about a $2.3 trillion market cap asset, that's real money moving around. Ethereum took a bigger hit, down 4.42% to $4,280, and here's the kicker. The total crypto market cap shed $75 billion. That's like the entire GDP of Luxembourg just vanishing into thin air. But here's what's interesting, and this is where it gets spicy. While Bitcoin and Ethereum were having their little tantrum, XRP actually gained 2.27% to $3.01. Now, that tells me something important about market dynamics that we'll get into later. The real story isn't just in the price action though. According to Glassnode data, all Bitcoin wallet cohorts are now in distribution mode. Translation: the smart money, the hodlers, the diamond hands, they're all selling. The accumulation trend score is showing weakening demand across every single cohort. That's like seeing all the lifeboats being lowered on the Titanic. It doesn't necessarily mean we're sinking, but it's definitely worth paying attention to. Trading volume hit $61.81 billion for Bitcoin alone, which tells me there's still plenty of liquidity in the market. But here's the concerning part. Open interest in derivatives markets is declining across the top 10 tokens. Long positions are unwinding faster than a cheap sweater, and that usually precedes either a major correction or a massive squeeze in the opposite direction. Now, let's talk about the elephant in the room, or should I say the Federal Reserve in the room? Jerome Powell is scheduled to speak at the Jackson Hole Symposium, and the crypto market is acting like a teenager waiting for their parents to come home after throwing a house party. Everyone's nervous, everyone's cleaning up, and everyone's trying to figure out if they're in trouble or not. The FOMC meeting on August 20th has traders positioning like they're playing chess with a grandmaster. The market is pricing in potential rate cuts, but here's the thing about rate cuts. They're usually good for risk assets like crypto, but the path to get there often involves some serious volatility. It's like getting a root canal. The end result might be good for you, but the process is going to hurt. JP Morgan just made what analysts are calling a game-changing Federal Reserve flip. When JP Morgan changes their tune on Fed policy, it's like your GPS suddenly recalculating your route. You might still get to your destination, but the journey just got a lot more interesting. Here's what's really fascinating though. While all this macro uncertainty is swirling around, we're seeing some interesting regulatory developments. The SEC is continuing to play their regulatory maze game with crypto ETFs, but they've already approved Bitcoin and Ethereum ETFs, which is accelerating institutional adoption. It's like they're saying, we'll let you play with the big toys, but you have to jump through our hoops first. Let me share some insights from the people who move real money in this space, because their opinions matter more than your cousin's hot take on Twitter. Peter Brandt, the legendary trader who called Bitcoin's 2017 top, just dropped some serious analysis that has everyone talking. He's tracking a 75-week pattern that suggests our current bull run has a precise expiration date. His prediction? Bitcoin could reach between $125,000 and $145,000 by September 2025. But here's the plot twist. He thinks there's a 30% chance Bitcoin has already topped for this cycle. If he's right, we could see Bitcoin back to $60,000 to $70,000 by November 2026 before the next major bull thrust to $500,000. Now, Brandt isn't just throwing darts at a board here. He's validating a cycle model that predicts Bitcoin at $280,000 by the end of 2025. That's either incredibly bullish or incredibly wrong, and in crypto both scenarios are equally possible. Standard Chartered Bank just made some waves by revising their Ethereum forecast. They lifted their year-end target to $7,500 from $4,000. And get this, they're projecting $25,000 by 2028. That's not some random crypto influencer making predictions for clicks. That's a major banking institution putting their reputation on the line. Their rationale: improvement in industry engagement and a significant uptick in institutional holdings. But here's where it gets interesting. While Standard Chartered is bullish on Ethereum's long-term prospects, the on-chain data is telling a different story in the short term. Glassnode's metrics show that all Bitcoin wallet cohorts are in distribution mode with weakening demand across every cohort after recent highs. It's like having your financial advisor tell you to buy while your accountant is quietly moving money to safer investments. The institutional sentiment is mixed, and that's actually valuable information. Goldman Sachs has been offering crypto loans to wealthy clients since 2022. JP Morgan is providing Bitcoin trading services, and Citigroup is investing in institutional-grade custody solutions. These aren't crypto-native companies jumping on a trend. These are traditional financial institutions that have spent decades being conservative, and they're now allocating serious resources to crypto infrastructure. All right, let's get our hands dirty with the charts, because this is where the rubber meets the road. Bitcoin is currently holding the $115,000 support level, and this level is more important than your ex's opinion about your life choices. Why? Because it represents a critical psychological and technical barrier that's been tested multiple times over the past few weeks. Looking at the daily chart, we're seeing a classic distribution pattern forming. The price action over the past week has been characterized by lower highs and equal lows, which in technical analysis speak means the bulls are getting tired and the bears are getting confident. The RSI is sitting at 45, which is neutral territory, but the MACD is showing bearish divergence. That's like your car making a weird noise. It might be nothing, but it's probably something. The 4-hour chart is even more telling. We're seeing a descending triangle pattern with resistance at $118,500 and support at $115,000. Now, descending triangles typically break to the downside about 70% of the time. But here's the thing about crypto. It loves to do the opposite of what traditional technical analysis suggests. It's like that friend who always shows up late but somehow makes it work. Ethereum's chart is painting a different picture, and this is where it gets interesting. ETH is showing more weakness than Bitcoin, down 4.42% compared to BTC's 2.54%. The ETH-BTC ratio is declining, which historically has been a leading indicator of broader market weakness. When Ethereum underperforms Bitcoin, it usually means risk appetite is decreasing across the crypto ecosystem. The volume profile is particularly interesting right now. We're seeing high volume at current price levels, which suggests this is a significant decision point for the market. It's like standing at a crossroads where one path leads to the moon and the other leads to the basement, and the market is trying to figure out which GPS to follow. Looking at the derivatives markets, the funding rates for perpetual swaps are turning negative, which means more traders are betting on price declines than increases. Open interest is declining, which typically happens when positions are being closed rather than new ones being opened. It's like a party where people are starting to leave, but nobody wants to be the first one to call it a night. Now here's what you came for, the actual trading strategy. But before I give you the playbook, let me be crystal clear about something. This is not financial advice. I'm not your financial advisor, your mother, or your conscience. I'm just a guy with charts data and an unhealthy obsession with cryptocurrency markets. Given the current market structure and the confluence of factors we've discussed, here's my approach for the next 24 hours. If you're risk-averse or new to trading, this is your lane. We're looking at a potential range-bound market between $114,000 and $118,000 for Bitcoin. The play here is to buy near support at $114,500 with a tight stop loss at $113,800. Your target should be $117,500, which gives you a risk-reward ratio of about 1 to 4. That's like betting $1 to win $4, which are pretty good odds if you're right. For Ethereum, the range is $4,200 to $4,400. Buy near $4,220 with a stop at $4,150, targeting $4,380. The key here is position sizing. Don't risk more than 2% of your portfolio on any single trade. I don't care how confident you are. The market has a way of humbling even the most experienced traders. If you're more experienced and comfortable with higher risk, we're looking for a breakout in either direction. A break above $118,500 for Bitcoin could trigger a move to $122,000, while a break below $118,500 could trigger a move to $112,000. $114,000 could send us to $110,000 pretty quickly. The key levels to watch are $118,500 resistance and $114,000 support. If we break above resistance with volume, that's your signal to go long with a target of $122,000 and a stop at $117,000. If we break below support, short with a target of $110,000 and a stop at $115,500. This is for the traders who like to swim against the current. Given that everyone seems to be expecting downside, there might be an opportunity for a squeeze higher. If we see a false breakdown below $114,000 that quickly reverses, that could be your signal for a contrarian long position targeting $120,000. The trigger here is a break below $114,000, followed by a reclaim within 2 hours. That would suggest stop-loss hunting by smart money, and those moves often lead to significant reversals. Let me talk about something that's more important than any trading strategy: risk management. I've seen more traders blow up their accounts because of poor risk management than because of bad market calls. It's like driving a Ferrari without brakes. You might go fast, but you're probably going to crash. Rule number 1, never risk more than 2% of your portfolio on any single trade. I don't care if you think Bitcoin is going to $200,000 tomorrow. Risk 2%, period. End of discussion. Rule number 2, always use stop losses. The market doesn't care about your feelings, your mortgage payment, or your vacation plans. It will take your money without hesitation if you let it. A stop loss is like a seatbelt. You hope you never need it, but you'll be glad it's there if you do. Rule number 3, take profits. This might sound obvious, but you'd be surprised how many traders hold winning positions too long and watch them turn into losers. If you're up 50% on a trade, take some profits. The market will always give you another opportunity, but it might not give you another chance to take profits on this particular trade. We can't ignore the macro environment because crypto doesn't exist in a vacuum. The Federal Reserve's upcoming decisions are going to have a massive impact on risk assets, and crypto is definitely a risk asset, regardless of what the Bitcoin maximalists tell you. If the Fed signals more aggressive rate cuts, that's generally bullish for crypto because it increases liquidity in the system and makes yield-bearing assets less attractive. But here's the catch. The path to rate cuts usually involves economic weakness, and economic weakness can trigger risk-off sentiment that hurts crypto in the short term. It's like being offered a promotion at a company that's going out of business. The promotion sounds great, but the context matters. The key is to watch the Fed's language around inflation and employment. If they are cutting rates because inflation is under control and they want to support growth, that's bullish. If they are cutting rates because the economy is falling apart, that's bearish, at least initially. While everyone's focused on Bitcoin and Ethereum, there might be some interesting opportunities in altcoins. XRP's 2.27% gain yesterday, while the broader market was declining, suggests there might be some specific catalysts at play. The ongoing regulatory clarity around XRP could be creating a different dynamic than the broader market. Solana is hovering around $182, and it's been showing relative strength compared to other large-cap altcoins. The ecosystem continues to grow, and if we see a broader market recovery, Sol could outperform. But here's the thing about altcoins. They're like crypto on steroids. When the market goes up, they go up more. When the market goes down, they go down more. So if you're trading altcoins, your position sizes should be even smaller, and your risk management should be even tighter. As we wrap up today's analysis, let me leave you with some final thoughts. The crypto market is at a critical juncture right now. We have institutional adoption accelerating, regulatory clarity improving, but also some concerning technical signals and macro uncertainty. The next 24 hours are going to be crucial. We have the Fed meeting, we have key technical levels being tested, and we have a market that's trying to figure out its next move. My base case is that we see continued volatility with a slight bias to the downside in the short term, but I'm prepared to be wrong. Remember, successful trading isn't about being right all the time. It's about managing risk, staying disciplined, and being adaptable when the market throws you curveballs. And trust me, this market throws more curveballs than a major league pitcher with a gambling problem. If you found this analysis helpful, smash that like button, subscribe for daily crypto insights, and hit the notification bell so you don't miss any updates. The crypto market never sleeps, and neither do we. Stay safe out there, manage your risk, and remember, in crypto, fortune favors the prepared, not the bold. Until next time, this is Boni, and I'll see you in the next one.